Good morning. It's Thursday, the 5th of September, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital, usually, but in transit right now. The take. India's affluent class has some tough choices to make. In many ways, it was inevitable. Countries like Canada and Australia have started tightening inflows, particularly for students. Australia has said it will cap the number of new international students at about 270,000 for calendar 2025, the lowest in 5 years, and down from about 560,000, almost 500,000 in 2023. Canada is tightening across the board for both students and foreign workers. Now, the details are several to get into here. The reasons are, of course, known and several. One, clearly, is the pressure external students are putting on infrastructure, including housing, which is limited in countries like these. Second is the evident misuse and abuse of the system, leading to distortions in the labor market as well. Fourth, and most important in my view, the not-so-soft issue of rising immigration, an increasingly sensitive voter issue in many countries, including in the United States. So whether it's Donald Trump or Kamala Harris who could become president, moving to the United States will be tougher than what it is, whether you're a student or something else. Now, these reversals will cause a blow back down the line, particularly for India's affluent class. The study overseas industry has boomed like never before. Just one segment, which is non-bank finance companies, have seen the education loan business growing 80% and 70% each year in the last 2 years. This year, education loans with NBFCs alone will grow another 40% to cross about 60,000 crore rupees, most of it obviously for overseas education. And amazingly, despite all this growth, CRISIL Ratings says that formal loans are only a small part of the funds mobilized. So families are obviously mobilizing elsewhere. Interestingly, the loan givers, that's the finance companies, are themselves pulling back right now, for example, for loans on Canada-bound university applications. But the attraction to go overseas is not slowing, despite increased friction, including paying presumptive taxes to the Indian government on money remitted overseas. Families continue to scrounge around to send their children for undergraduate study, where the chances of staying on are actually quite low from all the anecdotal evidence that I've seen. Many parents, both well-earning professionals as well as self-employed or those who run small businesses, would like their children to leave the country and ideally return only for family reunions. So what happens is options overseas shrink and opportunities in India stay roughly the same, particularly for this affluent class which has bet on mobility for the next generation and the promise of a better first world life different from what they've lived here. We're on the way to that. Tens of thousands of potential students will not make it to universities in Canada, Australia, England, or the United States in coming years, and I'm guessing other countries too. Even if they do, return is imminent for most, so it's back to the workforce here. To stomach this disappointment will be tough for all, even though a lot of money will be saved. India's economy continues to grow and surely can absorb talent, whether it's humanities or technology. But the domestic job market is facing its own stresses. Latest placement data from the top universities and colleges like IIT Bombay and IIM Ahmedabad suggests that median salaries are falling quite sharply. For IIM Ahmedabad's one-year MBA program, maximum earning potential MEP has dropped to a 6-year low after having risen in previous years, says the Economic Times. And some IIT Bombay students are apparently settled for offers around 4 lakh rupees a year. That's almost the same as a media job or less sought after industries. Now, if this is the condition of the top colleges, it will be tougher down the line or compromises will be higher. And on the demand side, IT companies are shrinking at this point and corporate India is hiring, but the rate is slow. And while the lure of entrepreneurship will stay, it's not the same as it was a few years ago when Silicon Valley venture funds opened the sluice gates and the most brainless ideas were supposed to reflect hidden genius. And finally, the horror stories that continue. Some 46,000 graduates and postgraduates applied for contractual sanitation worker roles or sweeper roles in Haryana state, according to the state, for a job that will pay around 15,000 rupees a month. The 395,000 applicants in all who have applied apparently know precisely what they would be getting into. The Hindustan Times quotes one applicant, a 29-year-old Rachana Devi from Sirsa, saying that the scarcity of jobs led her to apply for this position. Despite holding a degree in nursery teacher training and currently pursuing a master's degree in history, she has been unemployed for 4 years. Several other applicants, the report quotes, have B.Ed or Bachelor of Education degrees and are studying for their masters in different disciplines, but yet applying for this sweeper's job. India's incoming educated workforce, whether from here or returning from overseas, has to make some tough choices. First is to accept that going overseas will get tougher, and they may have to make their way around the Indian job market now or later. Second, they have to work harder to align with the job market, maybe sacrifice a little on perception and bury ego to get a good experience, maybe settle for even free internships to do so. Many smart young boys and girls are already doing this, and they don't need us to tell them. Hopefully, their staying back will lead to a better quality of life for all of us. And that brings us to the top stories and themes for the day. Indices fall as markets digest Wall Street's latest moves. Oil prices hit a 9-month low. Why it's good news for India. Car dealerships say inventories have risen further to 75 days. The rupee hits a fresh lifetime low. And how IPO prices perform, or initial public offer prices perform after a year. And finally, are Indian IT companies and stocks set to break out of a holding pattern that they have been in recent years?
This is the Core Report with Govindraj Ethiraj.
Wall Street and the Lal Street. Wall Street weighed heavily on Indian markets as they opened on Wednesday morning, falling and then recovering somewhat towards the end of trade. Global sentiments are now weak again. So it would be interesting to see if Indian markets can run on their own steam, notwithstanding the fact that domestic fund flow continues to be strong, though possibly not as much as in earlier months. So the Nifty 50 finally gave up its 14-day winning streak and dropped 81 points to close at 25,198, while the Sensex closed 202 points down to close at 82,352. Meanwhile, the rupee hit a record low on Wednesday, hitting a lifetime low of 83 rupees 98 paise to the US dollar in the last minute of trade. Remember, analysts who we've been talking to in the forex space have been telling us that the rupee is likely to depreciate in coming months, though very, very slowly and slightly. So the rupee finally closed at 83 rupees 9650 versus its previous close of 83 rupees 9675. So the gaps are very, very small. So in this case, it's a narrow 3 paisa range throughout the session, according to Reuters. Car inventories rise further. It's a worrying sign. Car dealerships are now saying that their inventories touched 75 days. Remember, they were ringing the alarm bells at 70 days of inventory or so. Money Control has quoted the Federation of Automobile Dealers Association saying that they're now holding about 750,000 cars, which will take 2.5 months to clear. So that's through the festive season, which we've been referring to and wondering whether indeed the festive season will absorb all this, or at least some of this excess inventory. Now, there is some disagreement between the car makers and the dealers on what the numbers exactly are, and we will get to the bottom of it in a day or two. But there is no doubt that the inventories are very high and hurting the channels. The larger question, of course, which we posed yesterday too, is what this reflects: a lack of pickup in older models, that's older car models, which is true, slowdown in demand because of weather-linked issues like heat waves followed by excessive rains, or a consumption slowdown, or a mix of all. Oil prices pause. So oil prices rose slightly overnight after falling to a 9-month low as Organization of Petroleum Exporting Countries, or OPEC Plus, discussed delaying their plans to increase supplies. Brent futures now have risen above $74 a barrel, following a 5% drop on Tuesday, according to Bloomberg. So things have actually turned quite a bit in the oil market. Bloomberg, again, for example, quoted oil forecasters from JP Morgan Chase to Standard Chartered, who had predicted a rally to $90 a barrel and beyond this quarter, based on two things. One, summer driving demand, mostly in the Western world, and supply constraints, or rather supply restraints by the OPEC countries. Instead, oil has wiped out all of this year's gains. The other factors that were perhaps not predicted are downbeat economic data from China and the United States, which have stirred fears over demand in the top two consumers, says Bloomberg. While on the other hand, a Libyan official has predicted a resolution to the crisis that had actually shuttered half the country's output. Now, some of these things, like restoration of production, could change faster, but others, like the China slowdown, would obviously take time to unravel. So all of this is good news for India, and paint stocks, for example, jumped because of the fall in crude oil prices. Stock prices of Indigo Paints, Asian Paints, Berger, Kansai, and AkzoNobel all rose, reported the Mint, including Asian Paints, which hit a 8-month high. The outlook for paint stocks was relatively weak until now. Now, whether all of this will translate into any lower prices at the pump for you and me, I think is a little early to say, but we will track this. Wall Street takes a dive. The big news in global markets was the fall in and on Wall Street on Tuesday, following which Europe and Asia also saw sell-offs on Wednesday. Asian chip stocks also fell thanks to fresh concerns over the AI frenzy, which I think are quite justified. The concerns. But the big fall was Nvidia, which plunged about 9.5% on Tuesday, wiping nearly $300 billion off the chip maker's market capitalization and pulling chip stocks across the board down with it, according to CNBC. So Intel fell about 8%, Broadcom lost 6%, AMD dropped about 8% too, and Qualcomm fell nearly 7%. So chip stocks, just to fill you in, have been rising in the past year on optimism that the AI boom will push companies to buy more semiconductors and memory to keep up with the rising computational requirements for AI applications. Now, a lot of this is being questioned, as we too are finding out in our conversations with folks in that space. But the sector has been led by NVIDIA, which dominates the market for AI data center chips, and the stock is still up 118% in 2024, according to CNBC, while other chip majors are obviously trying to get a foot in. So Intel and AMD also sell AI chips, though their market penetration is lower. Broadcom works on Google's TPU chips, and Qualcomm is promoting its chips as the best for running AI on Android phones, says CNBC. By the way, NVIDIA reported $30 billion in revenue for the quarter ended July. That was actually higher than Wall Street's already high expectations, but all of this, for current reasons, is not making the street happy. Where IPO stocks end up. We've been talking of the initial public offer boom here, and also the SEBI report, which talked about 54% of IPO shares were flipped within a week of listing in a study that tracked listings for about 18 months until December 2023. And maybe investors know better, or their action actually precipitates the fall that comes. So on one hand, of the 166 SME IPOs, for example, that listed in 2024, two-thirds gave at least a 50% return and 67 doubled their money. And many of those doubled on day one itself, till NSE or the National Stock Exchange imposed a 90% price cap a few months ago. However, after the listing day boom comes the real hurdle, as many investors resort to flipping, says Money Control. Shares of about half of SME stocks, 72 to be precise, that got listed in 2024 are now trading below their listing day's closing price, according to data from Prime Database, which Money Control quotes, saying that such losses also go up to 69%. Bajaj Housing Finance to go IPO. Speaking of IPOs, and since we spoke of small ones, let's talk about a big one. Bajaj Housing Finance is looking at a close to 5,800 crore rupee valuation for its IPO. That's about $7 billion almost. And that is likely to be one of the biggest IPOs this year, according to a term sheet that Reuters has seen. So Bajaj Housing Finance is the country's second biggest home loan financier by assets under management, and has apparently set a price band of 66 to 70 rupees per share for its $782 million IPO. The IPO is expected to run from September 9th to 11th. IT stocks could see a resurgence. So Indian IT stocks, or information technology stocks, have been on a reasonably strong wicket in recent months after falling out of flavor and favor with institutional investors for the last 2 years or so. Now that's changing, at least broadly, though it's not clear whether the latest upheavals on Wall Street, including a fresh reading on the economy, which is less positive, will change things. But many banks in the United States have said that they are stepping up spending on technology. If they do that, other sectors could and will follow, and that could flow directly and additionally into the coffers of companies like TCS, Infosys, Wipro, amongst others. So where will all this land? I reached out to Ajit Mishra, Senior Vice President Research at Religare Broking and IT industry expert, and I began by asking him what has led to the change in tone on IT stocks, and also how India's IT companies are geared for all of this internally.
Multiple factors basically which has led to this change in tone in the IT counters in last 6 months. The first and foremost is that there was almost like 2.5 years of underperformance that we were seeing. So there was valuation comfort in certain pockets which led to this recovery. But the major factor which we feel has led to this rebound, which is pushing the index and stocks to the record highs, is the possibility of a rate cut in the US markets. So that would positively impact the demand scenario, and the fear that we have around this recessionary fear in US markets and other factors. So that might result in quicker than anticipated rate cuts. So that would help, largely the IT counters. Another important aspect is that the sectoral demand, especially from the BSFI space, that has started showing green shoots. So that is also another positive factor which is positively impacting the stock prices.
If you were to go down to, let's say, BFSI, now I have been reading, for example, that some of the big banks in the United States are stepping up their IT spend. and have said that they will increase their IT spend. Now, would that mean that Indian IT companies could benefit directly? And are you seeing anything in the deal flows themselves that suggests that things are changing?
So at present, we are not seeing any change in the deal flows. But yes, as you have rightly mentioned, that in fact, in the BSFI segment, banking might take some time because we have this US election also scheduled. So they might take some time to adjust to the newer political environment, and then they might take the call. But other pockets are definitely showing some sign of recovery and revival. So from insurance and the other verticals, we might see some order flow first, and then eventually the big banks will also follow the suit. So as of now, I feel that largely they are also in the wait and watch situation. But as the management have shared, especially from the major IT companies, that they are positively biased towards the second half of this current fiscal. So maybe around the next 1 or 2 quarters, we'll start seeing the deal flows also accordingly.
Right. And I'm assuming the stock prices are also running up in anticipation of that. So if we were to look from within now, so let's say in the top 3 or 4 companies, that's TCS, Infosys, Wipro, HCL Tech, what's your sense? I mean, in a very broad, if we were to take a broad view of how they're coping with this current phase, I mean, there is costs are obviously high. They've all slowed down on hiring, if not actually gone on the reverse in the last year. Their obviously margins are under pressure. The top line is not really growing. So this is from an internal point of view. Do you see that changing, and what could drive that?
In fact, in the recent quarter, we saw a mixed trend. In fact, within the major players also, at some places we saw some uptick in revenue, and in some places there was marginal improvement in the margins as well. But as of now, there is no clear trend. And yes, so there were challenges related to cost and other factors. But the bigger factor was the attrition rate, which was dampening and causing major challenges to the IT companies, and plus the talent pool, especially for the new technologies like generative AI and others. So now they are focusing largely on that aspect. So internally, they are preparing for, let's say, this next demand revival. So the challenges that we were seeing, at least on the domestic front, related internally to the companies, they are working on it, and this is what they have shared during their management commentary as well. So hopefully this scenario would change, and plus the internal demand that we are also seeing for the cloud migration automation domestically also, that is also somehow helping them to cope up until we see the global demand re-emerging.
If you were to look at last couple of years, overall top line has been slow, and that's what the stock markets have also in a way recognized, that the growth is going to be slow, and now we're saying that's changing. But how much of that change can actually make, let's say, IT stocks more attractive, or are they running up too much in anticipation of what appears like relatively slower or rather only marginal increase in growth and profitability?
Govind, as we largely discount at least 6 months or 1 year down the line what are the expectations, so that is what we are seeing in IT also. So yes, in certain pockets we saw that the stock recovered, especially in the mid cap IT space, sharply, and then the post numbers the reaction was equally sharp. So I feel that barring the IT majors, in fact, if you exclude that Wipro in that list, other names are largely trading with modest optimism. It's not very high optimism because they have not done much in last, if you'll see, in the last almost 2.5 3 years, they have not gained much in terms of the price appreciation. So this recovery is just a catch up move in line with what we are seeing in the other sectors. So the actual action, I feel, is impending, and maybe by the next half we'll start seeing the outperformance maybe from the IT pack, which we have been seeing struggling for last couple of years.
Right. Ajit, thank you so much for joining me.
Thank you so much, Govind.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.